Asana was the classic pandemic stock, very high growth. It was the kind of company that you could see a massive future for, but that absolutely has not materialized in 2023. And the company just reported their most recent quarterly results, and there really wasn't a lot for investors to like. The stock is down 16% as I'm recording. And while this has been a stock that's been on my radar for quite a while, there has been a lot to like from this stock, founder led. Dustin Moskovitz has been buying stock like crazy, but there's just too many red flags to ignore. So that's what I'm going to dig into today. My name is Travis Hoium. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And thanks to this video's sponsor, The Motley Fool. Check out fool.com/ASYM for their top 10 stocks to buy right now. Let's just start with the quarterly report because this covers all the high level numbers, and then I'll get to some comparisons in just a second. These are the results for the quarter. You can see that revenue was up 18% year over year, $166.5 million. Operating loss improved from $101 million or 71% of revenue a year ago to $63.4 million or 38% of revenue. Now, this is definitely an improvement, but the fact that the operating loss on a GAAP basis is 38% of revenue for a company that's generating $166.5 million in revenue is pretty crazy. So let's just throw that out there. The net loss from a GAAP basis was $61.8 million. And cash flow from operations was negative $8 million. This is something that is actually really improved for Asana. The cash burn is not nearly as bad as it has been traditionally, but this is kind of the end of the good news for Asana. Overall dollar net-based retention, this is what you look for in a software company. Are they maintaining the revenue that they have from the customers, and then are they growing that revenue? So they adding services the customers are willing to pay for. Looks like that's not really the case, but they're keeping their SaaS subscriptions about flat for the quarter. And then we get into guidance down here. Revenue is expected to be $167 to $168 million, representing year over year growth of 11 to 12%. But the quarter over quarter growth is going to be a couple $100,000 because remember, revenue for the quarter was $166.5 million. So the growth engine has really stopped. And this is the biggest reason, is that this net retention rate is over 100%, but it's definitely not much over 100%. And traditionally for Asana, we've seen this be 120, 130%. They don't also seem to be adding customers at the same rate, or especially at the same price point as they have previously. Non-GAAP operating loss expected to be $23 million to $21 million. That is an improvement from the fiscal third quarter. Non-GAAP operating loss was $52.6 million. So that could be a positive point that they're improving the losses on an operating basis, but still losing a ton of money. On non-GAAP operating loss expected to be $66 to $64 million for all of fiscal 2024. I want to go down to the financials and go through just a few of the numbers that I have been looking for with Asana. The biggest one is these operating expenses. You want to see a company like this that is losing money, that's seeing its stock price fall, realize that they have to cut their operating expenses. This is something that a lot of companies across the board, across Silicon Valley have done. And the ones that have done it well have really been rewarded by the market. But we're not seeing a lot of improvement for Asana. A year ago, $227 million in operating expenses, far more than revenue. And now $214 million in operating expenses, still more than they're generating in revenue. So it doesn't matter how good your gross profit margin is if you're spending more on operations than you're generating in revenue. Where are they growing that? Where are they growing that spending? Well, a big chunk of it is going into R&D. That's typically fine, but you want to see payback on that R&D spending. And right now we are not seeing that with Asana. So that's why you're still having significant operating losses. The other thing that is always concerning with this company is stock-based compensation. And this is something that investors have been talking about for a long time, and it's getting worse. $53 million in operating expenses, despite layoffs for Asana, compared to $48 million in stock-based compensation. Now, this is a non-cash cost, so that's why management can say, well, we're almost near free cash flow break even, but you're increasing that share count, you're diluting shareholders. And this is ultimately a cost that you're going to have to pay for in one way, shape, or form. So $53 million in stock-based compensation, revenue of $166 million. That is a crazy level of stock-based compensation, a third of revenue. paid in stock. So I don't like any of those trends. And this is before we even get to guidance. And I want to put some of these current trends and the guidance that we see for next quarter into a little bit of context with a chart that goes back a little ways. Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. This is a look at quarterly revenue for Asana, and this goes all the way back to the beginning of 2020. And you can see that there was a steady drumbeat of increases in revenue every single quarter. The only blip in that was the April quarter for 2023, but then they got back to growth in the July quarter. And like I mentioned, next quarter, only expecting a little over $167 million in revenue, so only a couple $100,000 in growth. And so that's what I think is ultimately really alarming. Asana has always been a very expensive stock. Currently, the enterprise value to sales ratio is over 7, and obviously the price to earnings ratio is negative because the company isn't profitable. But you need to see if you're going to have to pay that kind of multiple for a company like this, you need to see growth, and that's not what we're seeing for Asana. So that's obviously a reason that the stock is down as much as it is today. The other chart that I think is really telling is the retention rate. And this has just been falling off a map for over a year. Like I said, 130% net retention rate as recently as 2 years ago, but that has dropped to now 100% overall. If this continues, we won't just see revenue flatline for Asana, we'll see revenue actually start to drop. And that's really a red flag, not only for the stock price, given the multiple that shares are trading at, but also the company overall. If you don't have a profitable company and your revenue is falling, you just start into this downward spiral. So I think these are really telling and maybe even chilling charts for Asana investors to be looking at. So what should investors be doing with Asana today? Well, like I said, shares are down 16% in trading on Wednesday, but surprisingly, shares are actually up 45% over the past year. Now they're well below their pandemic peak of about $150 per share, but it seemed to be that there was still a lot of upside with Asana. And I think that story has really ended because as good as I think their products are, you have to be able to ultimately make money with what you're doing. And Asana has not proven the ability to do that. It can't generate positive free cash flow. It's paying out too much in stock. And now customers are not paying more for Asana than they were previously. That net retention rate of just 100% and falling really rapidly is really concerning for a SaaS company like Asana. Now, the company has interesting tools coming out, talked a lot about artificial intelligence and how that could improve companies' workflows. So this is one of those cases where I think we need to separate the company and the stock and what we're paying for the business, because I really love Asana's products. That's what ultimately got me interested in the stock in the first place. And I think it was really bullish that Dustin Moskovitz was buying back stock like crazy, but you still have to build a business that's sustainable long-term and profitable. And I don't think that we've seen any evidence that Asana is doing that. As a result, I don't think this is a stock that's worth buying right now. I think there are just simply too many red flags. It's not. And the one that really puts me over the edge is the guidance number. If this is not going to be a high growth stock, then shares are way overpriced where they're currently traded. Investors can get much better deals with companies that aren't trading for 7 times sales and are trading for more like 1 or 2 times sales and are actually profitable. So I don't see a reason to own Asana shares right now unless the company gets its act together, reduces operating expenses, improves those margins, actually gets to positive free cash flow, and stops giving away the company in stock-based compensation. But what do you think? Leave your comments in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.